So probably two of the most common metrics used to evaluate investments are the NPV and the IRR functions. First of all, the NPV, or net present value. It's the value of all future cash flows, both positive and negative, over the entire life of an investment that are discounted back to the present. So that was a lot, but how do we evaluate NPV? Well, it's relatively simple. Any project with a positive NPV will add value to a company. Now, another very common function which gets used is the IRR function, or internal rate of return. And that's the expected compounded annual rate of return that would be earned on a project or investment over its life. So once we have the internal rate of return, how do we use that to evaluate a project? Well, if the internal rate of return is greater than the company's cost of capital, then the project will add value for the company. So again, it's good to know this theory about NPV and IRR, but even better is knowing how to calculate it. Let's jump ahead and look at the Excel template and figure out exactly how to calculate these two really common metrics. So as you can see, we're back in the Excel template here. Specifically, we're on the third tab labeled as NPV/IRR. Now the assignment is pretty straightforward. In this first cell here, we're looking for you to use the IRR function. In the second cell, we're looking for the NPV function. Now the NPV function may not give you the answer that you're looking for right away, but try and experiment with it a little bit. Hopefully you can get it to match the solution. Good luck. We'll see you soon. So let's have a go at filling in the template here, starting with the IRR function. Equals IRR. We're going to open the bracket, and we're going to select the values. So from this value all the way across to the end, hit enter. We've already got a checkbox over on the right-hand side. Perfect. Now let's try the NPV here. Equals NPV. Open the bracket. First thing it's looking for down here is the rate. So the rate is going to be the discount rate. Put in a comma. Now it's looking for essentially the values. So we're going to select all of these values like this, close the bracket, and then hit enter. You may have tried this, and in fact, you can see over here, we don't have a checkbox, so we've done something wrong. So here's the issue with the NPV function. If we tap F2, notice that it asked us here about the discount rate, and then it asked us about the values, but it asked us nothing about the timing, which means it's making an assumption about the timing. And the assumption that it's making is it's taking the first cash flow that it encounters, it's discounting it back 1 year. But actually, we didn't want that one discounted back 1 year. We didn't want that one discounted at all because that was year 0. So we're going to have to adjust the formula. What we want is we want this cash flow discounted back 1 year. So we're going to adjust the formula here, tap F2, and essentially instead of it starting in column D, we want to change that to an E like this. Now it's discounting 90 million back 1 year, 20 million is getting discounted back 2 years, etc., all the way to the end. Well, what do we do now about that first cash flow? Well, we go to the beginning over here and we tap F2 and we just add it in like this and put a plus sign. So we're grabbing the first cash flow in D7, we're leaving it undiscounted, and then we're using the NPV function to discount the remaining cash flows appropriately. Let's hit enter, and you can see we've got a checkbox over on the right-hand side. Nice work. So we have everything matching now. So the thing to remember about the NPV function is the first cash flow that it sees, it always discounts it back 1 year, second cash flow, discounted 2 years, etc., all the way through. Now, one thing to note about the IRR function is it can result in multiple solutions sometimes. So let's look at the cash flow profile. This is what we would call a normal cash flow profile, where you have negative cash outflows at the beginning, followed by positive cash inflows afterwards. So if we were to graph these cash flows, they would effectively cross the x-axis only once. However, if they were to cross the x-axis again, for instance, if we had a negative cash flow out here, then we could be into a situation where the IRR function would generate more than one result. If you ever have a cash flow profile that crosses the x-axis more than once, then what you want to do is rely on your NPV function to make decisions on whether or not you're going to invest in the project. Now, the NPV and IRR functions are great, But as we saw in the last example, they do have their limitations, particularly with respect to timing. Now, we can use the XMPV function. It's similar to the MPV function, but it's going to give us the ability to input specific dates. Now, similarly, we have the XIRR function. Again, it's like the IRR function, but we're going to have control and the ability to input very specific dates. So do we really need to use these functions? Well, yes, we do. Specifically, we need to use these functions when we have uneven or unusual dates or cash flows. In real situations, we're not always going to be faced with a cash flow profile that's perfectly spaced out 1 year to the next to the next. We might have some uneven spacing, and this is why we need to know how to use XMPV and XIRR. Let's jump into Excel now and see exactly how they work. So we're back in the Excel file. We're on the 4th tab here, the one labeled as year frac, stands for year fraction. What we want to do here is deal with uneven spacing. So we have the valuation date, and then we have all the cash flow dates across here. And we want to calculate here, we're asking you to calculate the discounting years. So what we're looking for there is, what is the distance in years between this date and that date? Looks like they're about 3 months apart, which is a quarter of a year. So we would be looking for you here to have a figure of 0.25, for example. So if we have 1/4 of a year distance here, well then how far is this cash flow from the valuation date? Well, it would be 1.25 years, for example, and all the way across here. So we want you to get the years in there, and then in here, we want you to manually discount the cash flows using those years which are above. Once you have the discounted cash flow figures across here, you can add them up here to get the MPV. So this will get you familiar with dealing with uneven cash flows or uneven timing here using manual discounting methods. Next up, we want you to go ahead to the next tab, which is titled XMPV XIRR. We want you to use those functions, XMPV here, XIRR there, and the same down below here. We've got one little gray cell there, which you might need to fill in as well, just to get everything working. Good luck with these 2 tabs, Year Frac and XMPV XIRR, and we'll see you soon. So let's start here on the Year Frac tab. In fact, the name of the tab, Year Frac, was a little hint. We actually want you to use the Year Frac function in here because it's designed to figure out the distance between 2 dates. Let's type in equals year frac. Now we can use the up and down arrows. We want to go down to year frac and hit tab, and it completes the function name. It's looking for the start date and then the end date. So the start date will be up here, the valuation date. We're going to tap F4 to lock that cell, put in a comma, and the end date is going to be right here. Let's hit enter. So now we can discount that cash flow. So put in an equal sign, grab the cash flow, divided by, open bracket, 1 plus, grab the discount rate here. We're going to tap F4 to lock that discount rate down, close the bracket, and put this to the power of 1/4 of a year, like that. And we can hit enter. So all we have to do now is grab these 2 figures, highlight across with the Shift key, hit Control R for fill right. We get the check boxes for both of them. Now that these cash flows are already discounted, getting the MPV is easy. We just use a sum function here, and we add up these discounted cash flows and hit enter. We're all set. So let's pop over to the next tab now with Control Page down for the XMPV XIRR tab. And down in here, we're going to use that function equals XNPV. We hit tab. It's looking for the rate, which is right there. Put in a comma. You can see now it's looking for the values. Okay, well, let's grab all of the cash flows here, put in a comma, and now you can see it's asking us about the dates. And this is where we select across here. We start with the valuation date and go all the way to the end and hit enter. So putting the XIRR in here should also be relatively simple. Equals XIRR. As soon as we see the name there, we can hit tab. It's looking for the values first up. So there's the values there. Put in a comma, and now it wants the dates. So we select from here all the way across, hit enter, and we've got all the check boxes. Now let's look at project B down below, right here. So let's go down here and use the XMPV function again, equals XN, hit the tab key. We're going to select the rate of 15%, comma. Let's grab the values starting with this empty gray cell here all the way across to the end, put in a comma, and now grab the dates from the valuation date all the way to the end here and hit enter. Now, if you have a value error in here, that's normal in the sense that we did this on purpose, just to highlight that you absolutely you can't leave this empty. You need to put a 0 in here if there's no cash flow. So let's enter 0 in there, hit enter, and this corrects itself. So essentially, if this is the valuation date here, then Excel needs you to at least put a 0 in for the cash flow on that valuation date. Let's try the XIRR now, equals XIRR. Hit the tab key. It's asking for the values here, and then a comma, and then the dates across like this. And let's hit enter. Now, instinctively, we should know that that is incorrect, because if we're generating a positive MPV, that would mean that the IRR should be higher than the discount rate of 15. So this is definitely incorrect. Let's see what's going wrong in here. If we tap the F2 key, we can see that actually what's going wrong here is that we need a negative cash flow as the first cash flow in the profile. So if we move this blue box over like that, move the red box over like that, it should work, because now it's starting with a negative cash flow, which is one of the limitations of the IRR and the XIRR function. If we hit enter now, we get the correct IRR of 19%. So you definitely need to know how to use XMPV and XIRR, because you're going to run into situations where you have uneven spacing between your cash flows. Definitely watch out for some of the limitations of these functions. Namely, your valuation date needs to at least have a 0 input there for the XMPV function, and for the XIRR and the IRR function, you need to start with a negative cash flow as your first cash flow.